I want to move on to bonds and talk a little bit. We've seen bond ETFs, great inflows this year as well. We just put up a screen about that. You have an active high yield fund that's seen inflows. Prices have held up. To me, this is quite amazing. It would seem this is a good sign, because if there was an imminent turndown, folks, high yield would sell off, right? I mean, it's credit, and it's risky credit.
Well, I think that the health of the credit markets is in some of the best shape that it's been. When you think about the last few years and where we've seen the move by a lot of companies and how they're treating their books from a credit perspective, the yield that you're getting off this is still really attractive. The yield to worst in the high yield space is usually highly predictive of where the credit markets are going to go in the 3 to 5 years in front of it. So I think what we're seeing is a continued interest in the health of high yield and what that can look like in a portfolio as investors start to think about how to redeploy some of this cash that has frankly been sitting on the sidelines for quite some time now.
It's amazing to me how much the viewers, investors in general, love their short-term. You have a short-term one too. Even though yields are coming down, we still see inflows into your ultra-short income ETFs. They love these 5% yields, but they're coming down. Even as they're coming down, it's remarkably sticky. Money market funds are holding up $6 trillion very well. They seem comfortable even at a lower level.
Well, I think what we see...
There's a behavioral psychology thing going on here. They still perceive there's a positive inflation-adjusted yield there.
Well, there's still, I think, a view too in the ultra short space that is a...
And here's your ultra short.
Increasingly, a better play than money markets, because when rates do decline, they tend to go very quickly in the money market space. They'll decline faster than you'll see in general in that ultra short income space. So for those that want to stretch out their duration a little bit, who might not be convinced of completely which way the market's going to go, that ultra short leg has been, I think, a good transition phase, and that's what we're seeing. We're seeing either people go into the ultra short, or they're just going out to long duration and just saying, okay, I'm going to try there.
You're still over 5% on this ultra short here, right?
I believe so.
Yeah, I think it's 5.5 as I recall, somewhere around there. I mean it's really remarkable.
It is, and I think what the conversations we're having, I don't know how much you're hearing about this, Todd, is also this a little bit, balanced is back, right? Which we haven't had that in a lot of years either. This thought that I really do need to look at both sides of that equation. I mean, people have been so focused on what's going on with rates and when are rates going to fall and what should I do in the fixed income portfolio and should I move out of cash now or later. Meanwhile, there's been 25% run in the last 12 months on the equity side of the books, and folks that sort of took that balanced approach have been in a pretty good place over that time period as well.
And we've seen the benefits, what they offer is an actively managed ultra-short bond ETF. So we've seen investors been embracing active strategies like Year, which Noel's team has, firms like products like Mint from PIMCO, JPST from JP Morgan, these ultra-short active fixed income ETFs that can go outside of treasuries to be able to find the best reward for that.
Well, explain that a little more. By the way, ultra-short is what, 30 days? What are we talking about mostly?
It's 1 year or less, right?
1 year or less, okay.
They'll flex, the products will flex anywhere from 6 months up to
and when
a year.
they can go outside of treasuries, what percentage would this have, for example, in a outside of traditional?
Again, it's going to vary by time period. We're very focused on our particular product on the liquidity piece, because you want to make sure that in sort of periods of volatility or steadiness, whatever it is, that the liquidity is there in an ultra short product. So things like securitized might only be 5% of our portfolio. There's going to be treasury repos. There's going to be a little bit of money market exposure there as well. So there's always going to be a blend just based on what's going on within the course of that year. And we'll dial duration up. Again, you might have a few pieces in there that'll go over, but on average, you're going to be at that 1 year or less. We'll go as short sometimes as down to 6-7 months duration, or we toe the line right up to a year.
So it's it's actively managed. It's not a money market fund where you're almost entirely. I mean, if it's a government money market, by definition, you're entirely in
right. But it's also not billed like the State Street product that's just treasury oriented. The benefits of active management is they can find where that best reward opportunity is from a liquidity standpoint, own corporates, own CP. which is a great addition for investors and advisors.
Yeah, and for us, the focus is we run a lot of income products across the suite of fixed income products at AB. So the same team that runs our income portfolios is running that ultra short income portfolio. So they're looking at that whole market and then trying to put their best thinking into that ultra short space to make sure we get that intersection of yield and liquidity.
Yeah, we just put up some charts of your Core Plus bond fund, which is, I gather is broad bond fund, treasuries, corporates, some high yield as well, right?
Yeah, correct.
Yeah, and corporate bond ETF as well, the EYEG. What kind of flows are we seeing here?
Yeah,
my impression is overall that it's still very good.
Yeah, these are newer funds. So they are. I'm trying to recall when we launched those products towards the end of last year. So these are still relatively new in the marketplace, but we're starting to see a lot of queries on this front, and this goes back to that. The ETF market's 30 years old now, and we have a lot of passive products in the marketplace, but so many of our conversations are, how can I take some of this active management? And you and I talked about this a little bit earlier, that the active funds today aren't the active funds of yesterday.
Yeah.
And so we're getting a lot of, how do we pair these together in model portfolios across fixed income strategies?
Yeah. So Todd, we have a record August for bond inflows.
Yeah.
I had Matt Bartolini on from State Street last week talking about this. Our investors, riff on what Noel was just saying, are investors distinguishing between short-term or long-term or treasuries versus corporate versus high yield? Look at these, $33 billion in August, a record for August. $190 billion, this is bond ETFs, not stocks. And the last time we had a record was $212 billion in 2021. Look, we're going to break the record here.
We're going to break it in September, quite possibly, because of investor adoption of ETFs. They like the liquidity, they like the accessibility, they like how easy it is to put these products into use. So to your question, TLT saw really strong demand. That's the 20-year Treasury ETF from iShares. It saw really strong demand in August as investors expected that the Fed was going to begin cutting rates and they could get rewarded for that. We did see some interest in the ultra short categories that we were talking about. We saw high yield demand. USHY, which is that iShares ETF, is now the largest. It eclipsed HYG in terms of the overall flows that we're showing here on the screen. And I just want to come back to active management within fixed income. It's fully being embraced as firms like Knowles, firms like Capital Group and T. Rowe Price and Fidelity bring their best managers into the ETF space. And we're seeing a lot of success from these firms that are either they've converted and now they're here to stay in the ETF marketplace, or they've launched those products and they're benefiting from the ETF ecosystem.
Noel, you've been around a long time. Where else do you see? Obviously, active management is a major part of things. Some of this is not your grandfather's active management. A lot of this, of course, is different than active stock picking. But what other growth areas do you see in the ETF business?
Yeah, well, I think what's fascinating is it's not only about the ETF, right? We're seeing so many different changes in the ecosystem around investing. So the active stuff is I think really positive. 30% of flows this year into active ETFs. So I think, and that builds on where we were last year. So such a good blend going on there. SMAs are another growth story in the marketplace. And again, it's always like these sort of unsung...
SMAs being separately managed accounts. Yeah, just want to make sure the viewers understand all that.
And then you've got...
So you people who have separately managed, these are funds that are managed for individuals or funds or companies themselves, and they convert them into an ETF.
They can. I mean, that's one arena. I think the mutual fund to ETF conversion is another piece of this. But I think, again, the unsung hero of the ETF is its operational flexibility, and using ETFs within the growth of the separately managed account space within unified managed accounts. So these are accounts that can hold mutual funds, SMAs, ETFs, all in one package. 25% of the accounts in the US today are UMA accounts, meaning you can hold anything within it. And investors are getting really savvy about how can I take the tax benefits of an SMA, marry it with the tax benefits of an ETF, take my low cost beta, park it next to my active ETF that might have, again, some tight combination of qualitative and quantitative factors and build optimal portfolios.
Boom, you've got a diversified portfolio.
It's pretty nice. It's a great time to be an investor.
It's a great time to have ETFs. It's so much fun. I've been covering ETFs, I'm trying to remember when, it's somewhere around late 1990s. And to watch them grow up like this is just wonderful, because not only are largely they're indexed and diversified, which is the old Bogle guy, that's my big thing, diversification, but low cost. And that was Bogle's other thing. You know, Bogle was never against active management. He was against high-priced active management. So here, even with active management, you generally have pressures to keep the fees down, which is what makes it successful.
Yeah, it's highly competitive. I think the you know, what you're paying for the active ETF in the marketplace, again, you can have a combined portfolio of active and passive and have a pretty low basis point average weighted portfolio and get the benefits of both views in there.